How's it going, you guys? My name is Andrew. Today is Sunday. I'm wearing a t-shirt over a collared shirt, and that's how you know I am a Silicon Valley data scientist. That is Professor Meatball. He is a doctorate from the University of Cornell, and we are going to cover something important, something mainstream. Forbes themselves are making a claim to the GameStop, not only as a saga in itself, so a four-part saga, four-part movie, three-part book, but we are also going to talk directly to the fact that they think that GameStop or GameStonk, trying to appeal to the masses, has nothing to do with the madness of the crowds. If you stay all the way to the end and smash that subscribe button early and that like button so that other apes can find out about this article, I would really appreciate that, because you're going to learn a ton from this video. So GameStop and GameStonk have nothing to do with the madness of the crowds. The GameStop GME eruption has been portrayed as the product, let me make sure that you guys can still see this, the product of a wildly irrational investor behavior, a frenzy, a speculative orgy, Charlie Munger's phrase, a game played by losers who don't have any idea what they're doing, a classic case of the madness of crowds. This view is incorrect. Observers are misled by the fact that the market is obviously not rational in the finance theoretic sense of the term. Share prices no longer reflect the underlying asset value. GameStop's mediocre money-losing business is certainly not 4,000% more valuable than it was at this time last year. This does not mean a decision of the GME traders. Hold on a second. This does not mean that I'm gonna make this a little wider because that way I can see more. Okay, this view is incorrect. The observers have misled by the fact that the market is obviously not rational in the finance theoretic sense of the term. Share prices no longer reflect the underlying asset value. GameStop's mediocre money-losing business is certainly not 4,000% more valuable than it was this time last year. But this does not mean that decisions of the GME traders are irrational. The GME event is in fact the result of a process that is hyper-rational. It is based on highly accurate calculations of specific outcomes which possess a much higher degree of certainty than it is the case for normal investment decisions. There is no madness of the crowds here. It is a premeditated, predatory takedown of a cornered and defenseless counterparty. Here's how it unfolded. Okay, the standard assumptions that don't apply. The naive view of the stock market is based on two assumptions that seem self-evident. Investors buy or sell particular stocks based on the price and whether they think the share price accurately reflects the underlying value of the business, and the market is a free market. Investment decisions are fully discretionary. This is how we are taught, basically from childhood, to think about the stock market as a vast convenience store full of investment offerings, all tagged with their respective prices. We are free to wander up and down the aisle, so to speak, to study the merchandise and decide which offerings are the most attractive. We make our own decisions. No transaction is forced upon us. There are many situations where one or both of these assumptions are invalid. 1. Price-insensitive transactions. Many stock transactions are in fact executed without regard to the share price and are thus also disconnected from any consideration of the company's fundamental value. Now, this is pretty big. Remember, this is a lot about perception. Passive index tracking investment funds do not transmit information about the price value relationships of an individual components. Imagine that. In a free market, we assume that when the price gets too high, what does that mean, too high, by the way? When a price gets too high, people are going to buy less of it, and then it becomes a buyer's market. If a price becomes too low, then people are going to buy more of it, and then it becomes a seller's market. The problem with this analogy is that if this price insensitive transactions theory is true, for example, you know that GME is going to go high, and it doesn't matter where GME is, $100, $120, $140, even if the paper handlers and the retail investors start to get in at $400, that still might not be too high for them. Right? The value of the stock is disconnected from the fundamental value of the company. Passive index tracking investment funds do not transmit information about the price value relationships of the individual components. Michael Burry, the star investor of the Big Short fame, told Bloomberg News Passive investing has removed price discovery from the equities markets. The simple theses and the models that get people into sectors, factors, indexes, or ETFs and mutual funds mimicking those strategies, these do not require the security level analysis that is required for true price discovery. When we buy a share from an index tracking ETF like the SPDR, we are buying all 500 companies in the index, regardless whether they are overpriced or underpriced. When a month or a year later, we sell that share of SPDR, we are effectively selling the shares of all 500 companies at once. In the interim, some of those companies have surely done better than others, and different companies now are overpriced or underpriced. These shifts have no bearing on the decision to sell. We are selling them all indiscriminately, simply because they're in the index. If a company is added to the index, the ETF managers have to buy it, regardless of the price. If it is dropped, they must sell it, regardless of price. They have described in the process in the previous column with respect to test this run-up since November of last year. There are several important sources of price insensitive and thus value insensitive buying and selling stocks. Let us figure out exactly what are some actual concrete examples of price insensitive behavior. 1. Corporate share buybacks, notoriously insensitive to value in many cases. 2. High frequency trading and market making, focused on small eddies in the order flow that create opportunities to exploit the bid-ask spread. This is all about incentives, and especially since this is a lot of the ways that Robinhood ultimately makes money, or Webull ultimately makes money, you have to think about it. Well, this is entirely insensitive to the price of the stock. Many forms of algorithmic and quantitative trading that exploit small temporary deviations from prevailing patterns, okay, unrelated to long-term company fundamentals. And then finally, even basic momentum trading is quasi-insensitive to the price-value relationship. Trend followers buy a company's shares because they believe the trend will continue, not because of their assessment of the price of the shares relative to the value of the business. And this is very important because oftentimes when we do quick and dirty ticker symbol suggestions from the chat, we ultimately do make a momentum-based decision before we get to be able to see the earnings report and dig a little deeper into the data itself. And data is king. What's up, Angel Flores? Thanks for joining us. Just woke up. JP Morgan has estimated that only 10% of the trading volume in the market today is based on the old-fashioned research-based discretionary investing. The other 90% of the trades are fully or partially price insensitive. This dilutes the price-related information which the share price supposedly contains, a precondition for a second and more brutal type of market dislocation. If you guys are just listening in, we are talking about how Forbes themselves think that GameStop is a trend that does not have anything to do with the madness of the crowds. Forced trades, the idea that all trades are entered into voluntarily, which would seem obviously true, is in fact false. There are many situations in which one side of the trade is undertaken during duress, involuntarily, and without flexibility of execution. These situations can be exploited by traders on the other side of the transaction who take advantage of the fact that their counterparties have little or no room to maneuver. A margin call is one example. Investors who have borrowed money to buy shares find themselves forced to sell at exactly the wrong moment and at a loss if their share price falls too far below its collateral value. This is just, remember, any investor, if you buy on margin, which means buying shares with money that isn't yours, either long positions or otherwise, this is exactly the same kind of risky behavior that the hedge funds had gotten into by trying to short. Shorting is essentially borrowing shares to sell, whereas buying on margin is borrowing money to buy. Forcing selling is familiar, but is there such a thing as forced buying? Yes, there are several institutions in which a market participant has very little option but to buy shares, and often at a highly disadvantageous price. Cornering these forced buyers and feasting off their distress is another one of these ancient arts of the marketplace. This is the key to understanding the GME event. If you guys are watching, this is going to be a comprehensive understanding of just mathematically, just logically, what is happening. If you still are unclear of what is the GME squeeze, what exactly is going to force a cataclysmic event in the market, then I think you should continue listening. 21st century high-tech corner. Great corners of the past in gold, silver, copper, onions, chocolate usually failed. What happened with GME is that predators Reddit, figured out how to design a novel and extremely effective corner. They did it by combining possibly for the first time two different techniques. A short squeeze, an ancient, reasonably well understood and quite hard to execute, which we have covered on the channel many times. A recent innovation called a gamma squeeze, which added the leverage the Reddit swarm needed to power the corner and flip it to our advantage. So it seems like even Forbes believes that this is history making in itself. A short squeeze, which happens when there is so many shares not available in the market that the irresponsible people who borrowed sells from a future decided to borrow a share, sell it, and now has no option but to buy it back from someone at any price. Now has to face the consequences of being cornered into a buy action. A gamma squeeze is something that is not quite the same, actually. When we talk about gamma squeeze, we're talking about call options, and when you have the option to buy a share at a certain price, the institution that sold you that option might have to hedge their bets by buying up the share themselves while your strike price is still above the price of the stock. When it gets too close, they delta hedge, which means they buy the stock up ahead of time in anticipation that you were actually right in your bet, and that causes the price to move upward as well. The short squeeze. The short sellers sell borrowed shares and hold the cash. They hope for a decline in price so they can buy back those shares for less than the money they received from the short sale. If the share price rises, their position loses value because the shares would have to be bought back at a higher price, inflicting a loss on the short seller. There will be a margin call to post more collateral. If the shares rise too much, the short seller is forced to buy back, cover the short at a loss. This is the squeeze itself. This forced buying puts further upward pressure on the price, which squeezes other short sellers still holding out. When they cover at an even greater loss, their buying drives the price still higher. The squeeze can send the price soaring. This is the effect we have been waiting for. This is the effect that I just described. This scenario attracts new buyers, the longs. They buy shares that they will later sell to the desperate shorts at the top of the squeeze. The traditional short squeeze is a slugfest. The shorts do have a built-in advantage, however. As they defend their position by selling more, they gain cash. The longs have to use cash as the battle proceeds. The Porsche Volkswagen case. Yes, this is a beautiful case that is not entirely relevant. Many of you in the comment section already know this, but this is one of the great short squeezes in recent history, involved in an attempt by Porsche to take over Volkswagen. Despite the fact that Volkswagen is over 10 times larger than Porsche by sales, the smaller company was able to engineer the squeeze and acquire a majority voting interest in Volkswagen equity. The short sellers were savaged. Wow, that is pretty interesting language from the hedge funds, from Mr. Forbes themselves. Intraday trading at the height of the squeeze, October 27th to 29th, was even more extreme, with swings of nearly 100% in a few minutes. The case is extraordinary because the target's massive size. As the squeeze played out, Volkswagen became briefly the world's most valuable company. And if you guys are ready to be on the right side of history, GameStop and AMC might be as well. The Porsche strategists added a new wrinkle, secretly acquiring options on top of the shares they owned. Porsche revealed that it owned 42.6% of the stock and had acquired options for another 31.5%. The shorts scrambled to cover and the price leaped. On paper, Porsche made some 6 to 12 billion euros. To put those numbers into perspective, Porsche's revenue for the whole year was a bit over 7 billion euros. So Porsche's CEO was charged with market manipulation. Oh my God. And then the leading short seller committed suicide. Holy moly, this was a heavy lift to engineer the event. A traditional short squeeze requires a huge amount of ammunition on the buy side to corner the short sellers and force them to cover. This is what the Moon Platoon, the Space Apes, the Guerrilla Gang is currently doing. We are the ammunition, and that is why this message is so important. That's why smashing that like button is so important, to make sure this message continues to be a hard-won war, a hard-won battle, and making sure that people are educated about the exact mechanics that are going on. Some mechanics that even Forbes, a large institution, is willing to report on. Going dollar for dollar against the shorts is very hard. Porsche's move took 3 years of careful planning, which is why successful squeezes are so rare until now. the GME gamma squeeze. The game-changing maneuver is called obscurely a gamma squeeze. It is a recent invention. If you Google the term, there are fewer articles older than January of 2021. It is a clever and powerful. It also uses options to intensify the pressure on the short sellers, but in a different way. Here's a real example. It began with buying a Tesla call option. The numbers are real. On February 26, Tesla closed at a price of about $675 a share. 2 days earlier, Tesla had closed at $742. 2 weeks earlier, it was at $816. This is around where I bought Tesla. So once again, be careful because apparently history continues to repeat itself. You buy an option to purchase a share of Tesla at $725. The option expires in 2 weeks on March 12th. The option costs $15. If Tesla's price rises above $740, $725 plus our $15 on or before March 12th, you make money. If the option expires on March 12th and the stock is still below $740, you lose $15. If Tesla's share price rises back to $816, the option is worth $76. The return on your $15 investment is over 500%. In contrast, if you had bought a share of Tesla at $675 and sold it at $816, your return would just be 21%. The risk-return relationship is asymmetrical. The downside is limited. The upside is unlimited. Let's make that clear. The upside is unlimited. This is insanity. Option economics and illustration. A Tesla $725 call option expiring March 12th. You see, however much Tesla continues to rise, that is how much profit you can take. And the premium is only going to be finite every single time. But who sells you the call option? What does his risk contour look like? Your counterparty is almost certainly a market professional with experience in pricing and selling options. The structure of his risk is in inverse of yours. His upside is limited to the value of the premium here. The downside is unlimited. If he writes a naked call option and the price rises, he is on the hook to deliver at the strike price. He will have to buy in the open market at $816. He would lose a net of $76. And this is the crux of this chart here. Now, I know you guys, charts are art, which is something that I have to make it clear to you guys. Profit loss calculation for a 2-week call option on Tesla. What we have here is the call buyer's P&L. That's most likely you. If you have ever been participating in a gamma squeeze against the institutions, this is your possible profit and loss. And over here on the y-axis is how much we are going to be able to make or lose. You see, at the very beginning, we have a possibility of losing $15 just straight up, but we'll never ever lose more than $15 because we don't have to buy the stock. This is why it's called an option. Now, on the other side, they stand to gain $15 until we hit that strike price, in which case they make nothing. And then they can, if they would naked, as in they did not buy the share ahead of time, they are now going to be in a very bad way, infinitely on the hook based on how high the price of the stock goes. Now here is where the delta hedging can happen, because right before we hit that strike price and the call seller's P&L, the person that sold you that option, they have the possibility of making immensely big losses for themselves. So they buy the stock ahead of time, and that is why we keep on this live stream. You guys might have noticed I say we have to get above this price, and then we have to get above this price. That is so that these strike prices become in the money, and when they are approaching to be in the money, delta hedging could occur, which means that they try to buy the stock before it hits that price. Okay. Consider the difference this makes in the psychology of the buyer and the seller of the option. The buyer can view this as a simple wager. He may lose at most $15, but he can win many times that amount. The seller can only make $15, but stands to lose heavily if the stock moves up. In effect, he has also assumed the same risk as a short seller. Given recent history of Tesla, this is not a risk that a professional would accept. He has to hedge it he has to hedge it somehow, and this is what we were explaining with delta. The risk can be hedged in many ways, most of them too complicated to explain here. The simplest is for the seller to buy a share of Tesla at 675 when he writes the option. This is a covered call, the opposite of a naked call. His risk of big up move is eliminated, and he now has the risk of a downside move, but he can ignore this for now. This transaction is not quite forced. The seller could take, so this is a covered call, so we saw a naked call before, and now we saw a covered call. So the difference here is that the call seller's P&L, right, it is no longer, it goes to a negative infinity, but the call seller's P&L with a naked call is the one that goes to negative infinity. This transaction is not quite forced. The seller could take the risk and go naked. He could, hold on, let me scroll. There we go. He could find other ways to hand off the risk by buying or selling other sorts of options. But in most cases, writing a call option will trigger someone somewhere to purchase of a share of the underlying stock as a hedge. And this is kind of where hedge funds come from. This gives us the nomenclature at the very least. The key to the gamma squeeze is this. Call options are a much cheaper way to apply the pressure on the shorts. In this example, the option costs just 2% of the cost of buying a full share of Tesla. This tilts the game dramatically in favor of the orchestrators of the squeeze. With just 2 cents of an at-risk investment, they can force the shorts to take on $1 of new risk. So even with the shorts liquidity advantage, this is now a different battle. It opens the game up to the retail swarms that mobilized around GME on Reddit. They targeted the huge exposed short positions in GameStop, well over 100% of the company's outstanding float, where before it required major financial muscle to even attempt a corner or a short squeeze. Now huge numbers of small traders can join the game. The tipping point is quickly overrun. The shorts are forced to cover. The strategy is hyper rational because the degree of certainty is very high. Betting on the share price movements based on the ordinary ebb and flow of information in the market is much less certain than betting that buyers who are forced to buy will in fact buy. And if the gamma squeezing trader can position so that forced buyers have to buy from him, that's money in the bank. And that is why we are saying, if you believe this saying, hodl, right? If you guys are holding, that is basically forcing someone in the future to buy from you. And that is money in the bank if a squeeze successfully happens. This is not financial advice, of course. This is just the theory itself. GameStop is the first prominent example of this novel tactic. The market's understanding of this phenomenon is still incomplete. It is not clear how much leverage the gamma squeeze adds quantitatively, or how repeatable it is, or how stable. Could it break down just as easily with a counter surge of put options? Well, which could exploit this new downside risk implicit in the covered call. Frankly, this writer doesn't even know, but it seems like that attempts to execute this technique are growing. The daily volume on options trading in the US has doubled in the last 2 years. The strongest increase has come from retail traders just like you. The new squeeze technique constitutes a dramatic example of a more general phenomenon, the structural disconnection of investment decisions from traditional price and value concepts, which can create situations involving coercive asymmetry in certain trading relationships. This just means that there is no longer a free market when it comes to trying to build this asynchronous way of building value and speculating value. Suddenly there is a very big gap over what I want to buy at a certain time and what I promise that I will buy or sell at a certain time. When buying or selling can be forced, it can alter investor psychology and lead to market dislocations that may be severe. And that's it. And that is it. I hope you guys had a good big brain explosion on your Sunday just now, because this is important. The way that this article is structured is one from the institutions, the big like news reporting, the big organization's point of view. Forbes is a big player in the financial market, so their perception of everything matters. This is why we go and wait for the FINRA report. This is why we go and learn about these financial maneuvers, because perception is king. So now I'm going to ask you to perceive. What do you think? Every comment that you write on this video is going to change someone else's perception. Every comment you guys leave in the live chat is going to change someone's perception. So we are here to continue the message that GME is not going anywhere. The GME is continuing to be a force very much making history, and AMC is also in tow. We have to bring these two stocks into the limelight, and that is why we are here to tell you, without financial advice, exactly the mechanics of what's going on. If this video was helpful to you, share it with someone else, because this was probably the most comprehensive overview of the mechanics from a big institutional player. If you guys like this video, make sure to like it. If you guys wanted to keep on learning and investing in yourself, the best way is to drop your meatball sub and join the Moon Platoon down below. I'll see you guys in just a second. I want to show all of these people that have helped out the show, people over there with the Meatball the Professor tier, and people over here with the Meatball the Space Legend tier. For now, but not for forever, I hope you have a great day, and I'll see you guys on the moon.